Welcome to my channel. World Scene News. Subscribe to my channel for news updates all around the world. In early 2024, Germany and Japan, both recognized as global leaders in railway technology, made a stunning and unexpected announcement, one that would send ripples through the entire transportation industry. They declared a ban on the export of their most advanced high-speed train components to China, a move that caught many by surprise and signaled a dramatic shift in international cooperation. These weren't just ordinary parts, these were the crown jewels of rail innovation: maglev guidance systems, next-generation braking units, and highly sophisticated precision control software. Suddenly, these critical technologies were off-limits to one of the world's largest markets. For decades, these components had kept German and Japanese firms at the very top of the global rail industry. China, with its rapid expansion and ambitious infrastructure projects, had long been their biggest and most lucrative customer, fueling growth and innovation on both sides. The ban sent shock waves through global manufacturing. Factories around the world scrambled to adjust, and headlines buzzed with speculation about the future of high-speed rail. Contracts froze overnight, supply chains unraveled, and boardrooms in Munich and Nagoya scrambled to assess the fallout. Executives faced tough questions about lost revenue, stranded projects, and the long-term impact on their company's global reach. Officials from both countries cited national security concerns and the urgent need to protect intellectual property. They feared that if China gained access to these technologies, it could reverse engineer the innovations and eventually outcompete them on the world stage. This was a preemptive strike, a calculated gamble to maintain their technological edge and prevent their hard-earned expertise from being copied or surpassed. The world watched closely as China, home to the largest high-speed rail network on the planet, suddenly faced a dramatic cutoff from its main suppliers. Assembly lines slowed, and uncertainty loomed over future projects. The era of open technological exchange was over. The stakes had shifted. Now, it was a contest for survival and dominance in a fiercely competitive global market. Germany and Japan were betting that China couldn't easily replicate their most advanced technology, and that the pressure would eventually force China back to the negotiating table, seeking compromise or new agreements. But no one could predict if this bold move would pay off, or if it would backfire, accelerating China's own innovation and pushing the world into a new era of rivalry. The global race for railway supremacy had just entered a new, unpredictable phase, one where alliances, strategies, and the very future of high-speed travel were all suddenly up for grabs. The export ban wasn't just about economics, it was about de-risking. For years, Germany and Japan had supplied China with the most advanced train technology, fueling the rapid modernization of its railways. But as China's ambitions grew, so did the risks of sharing their hard-earned expertise. Germany and Japan had grown wary of their dependence on China, fearing it could be used as leverage. The economic ties that once seemed mutually beneficial now looked like potential vulnerabilities, especially as global tensions rose. The ban was a loud signal. They would no longer risk their future by empowering a rising competitor. It was a move to protect not just their industries, but their national interests and technological sovereignty. Intellectual property theft was a major concern. Joint ventures often meant handing over sensitive designs. Over time, these partnerships blurred the line between collaboration and competition, making it harder to keep secrets safe. Chinese firms, like CRRC, were catching up fast, threatening to undercut German and Japanese dominance. With each new contract won by a Chinese company, the pressure mounted to defend their home turf. By cutting off advanced components, they hoped to slow China's progress and buy time to innovate. The goal was to maintain a technological edge, even as China poured resources into catching up. The move also fit into a broader geopolitical strategy, aligning with US efforts to contain China's technological rise. It was a rare moment of unity among Western allies, all seeking to shape the future of global industry. It was a calculated risk: sacrifice short-term profits to protect long-term leadership. For many companies, the decision meant walking away from lucrative deals, but the alternative was losing control over their own innovations. But it was also a message to the world: the West would defend its technological advantage, even at a cost. The stakes were high, and the consequences would ripple across global supply chains. The ban was as much about strategy as it was about economics. It was a chess move in a much larger game, where every decision could tip the balance of power. Germany and Japan were drawing a line in the sand. They were making it clear that some technologies were simply too important to share. The global balance of power was shifting, and they were determined not to be left behind. In a world where technology shapes destiny, holding the keys to innovation could mean the difference between leading and following. China didn't panic. It mobilized. In the face of sudden restrictions, the country's response was immediate and resolute, drawing on a deep well of national pride and collective determination. The government framed the ban as Western economic aggression, rallying engineers and scientists nationwide. State media broadcast urgent calls to action, and leaders emphasized the need for unity and innovation. Billions were poured into Iron Dragon, a crash program to domestically produce every banned component. Funding flowed rapidly, and new research centers sprang up almost overnight. Universities, research institutes, and state-owned giants joined forces, cutting through bureaucracy with wartime urgency. Collaboration replaced competition, as everyone worked toward a single goal: technological self-reliance. Chinese firms reverse-engineered existing parts, recruited top talent, and filed a surge of new patents. Teams worked around the clock, determined to close the gap with global leaders. Within a year, prototypes of homegrown maglev systems and braking units were rolling out. These breakthroughs were celebrated as symbols of resilience and ingenuity. They weren't perfect, but they worked, and they were Chinese. Each success fueled more ambition, and the pace of progress only accelerated. By late 2025, China was integrating its own tech into new high-speed trains. The transformation was visible on factory floors and in the pride of workers. The ban, meant to cripple China, became a catalyst for self-sufficiency. What was intended as a setback became a turning point in China's industrial story. China leapfrogged years ahead in its quest for technological independence. The world watched as the nation redefined what was possible in record time. The dragon wasn't slowed, it was unleashed. China's innovation engine was now running at full speed, setting new standards for the industry. Germany and Japan had forced China to innovate faster than ever. The competition had raised the stakes, and China was now a peer among giants. The global tech race had a new, formidable contender, one that had turned adversity into opportunity and was now shaping the future of high-speed rail. China struck back where it hurt most: rare earths. In mid-2024, Beijing restricted exports of critical metals like gallium and germanium, essential for German EVs and Japanese electronics. Prices soared, and supply chains snapped. Germany's auto industry and Japan's tech giants faced production crises overnight. China controlled over 80% of these materials. There were no quick alternatives. The retaliation exposed just how vulnerable Germany and Japan were. The ban on train parts had triggered a much broader economic conflict. China proved it wasn't just a consumer, it was a gatekeeper of global industry. The lesson was clear: in a world of interdependence, every action has a counter-reaction. The trade war had escalated, and the pain was mutual. The economic fallout was immediate and brutal. German and Japanese firms lost their biggest customer overnight, China. Earnings plummeted, stock values crashed, and order books dried up. But the real blow was global. China, now a competitor, began undercutting them in international rail projects. Countries once loyal to German and Japanese tech now had a cheaper, homegrown Chinese alternative. Meanwhile, China's rare earth ban crippled German EV production and Japanese electronics. The disruption rippled across industries. Cars, phones, green tech, all felt the shock. The myth of indispensability was shattered. Dominance was no longer guaranteed. The ban, meant to secure the future, had made it more uncertain than ever. The cost was measured not just in money, but in lost confidence and influence. The backlash at home was fierce. In Germany, industry leaders clashed with politicians, blaming the ban for job losses and economic pain. The ruling coalition fractured, security hawks faced off against business pragmatists. Public anxiety grew as iconic companies warned of layoffs and recession. In Japan, corporate giants lobbied hard for a policy reversal, fearing for their investments and supply chains. The once united front crumbled, replaced by heated debates and calls for compromise. Some wanted to double down. Others urged a return to engagement with China. The disunity sent a clear signal. The pain was real, and the resolve was wavering. China watched as cracks appeared in the alliance. The crisis forced a strategic reset. Germany softened its stance, quietly seeking dialogue while resisting broader EU crackdowns. Japan launched a fund to help companies diversify away from China, investing in Southeast Asia and rare earth alternatives. China doubled down on self-reliance, expanding its Made in China 2025 ambitions to other sectors. Beijing used rare earths as leverage, rewarding cooperation and punishing confrontation. The conflict evolved into a complex chess game, no longer black and white but shades of gray. Germany sought a middle path, Japan built economic buffers, and China accelerated its technological independence. Each nation adapted, learning from the pain and recalibrating for a new era. The world of global trade had changed, cautious, fragmented, and fiercely competitive. The lessons were harsh, but the strategies were smarter. The next moves would define the future. The ban sparked a surge in gray markets and creative loopholes. Smugglers and middlemen routed banned tech through third countries, making enforcement a game of cat and mouse. Chinese firms paid premiums for critical parts, while German and Japanese companies sold light versions that skirted the ban. The result? A messy, less transparent system where technology still flowed, just less openly. Export controls proved hard to enforce in a globalized world. The policy created new winners, intermediaries and workaround specialists. The intended clean break never materialized. Instead, the world adapted, bending the rules to keep business moving. The lesson technology once released is nearly impossible to contain. The train parts ban rewrote the rules of global trade. Trust was shattered, relationships became transactional and wary. Technology controls, meant as a knockout blow, only spurred China to greater independence. Germany and Japan paid a steep price, lost markets, profits, and prestige. The world took note. Economic nationalism and supply chain resilience became top priorities. The era of just-in-time efficiency gave way to just-in-case caution. The story is a warning. Interdependence is both strength and vulnerability. Containing a determined rival is harder than it seems. Every action has global consequences, often hurting the aggressor as much as the target. The journey ahead is uncertain, and every nation is now writing its own timetable.